I thought it would be quite useful to put down a few revision questions for the ACI Dealing Certificate, not just to show you how to do the answers, but also just to show the thought process. So what I've done is just put together a handful of questions, just about 6 or 7, on FX, repos, futures and interest rate swap payments. The key thing to this test though is just read the question. Now let's take an easy one on repos. So we have here the 1 month or 31 day GC, General Collateral Repo, rate for French government bonds is quoted to you at 375 to 380. Now let's just stop there. It's quoted to you, so that means you're not in control of the price. You're the price taker, not the price maker, so it's quoted to you. As collateral, you're offered 25 million euros nominal of the 5.5% OAT maturing in 20 whatever, which is worth 28,137,500. Now you'll know from elsewhere in the ACI, OAT is a French government bond. Now it says here, as collateral, you are offered. So if you're being offered collateral, that means you're lending cash in its place. So you're the lender here, and if you're lending money, the bank will pay you 375. They will pay you the bid side as little as possible. So already, what do we know? We know the maturity for the repo, we know you're the price taker, and we know the rate you're going to pay. Now we know the market value, not the face value, the market value of the collateral is 28,137,500. Now you as the lender have decided to impose a 1% margin. What that means is you're concerned that the collateral may fall in value. So you're not going to lend the full amount of the bond's worth, you're going to reduce it a little bit. Now if you impose a 1% margin, what you do is you take the market value of the collateral and divide it by 1.01. If you'd imposed a 2% margin, you'd divide it by 1.02. So basically you're reducing the actual amount you'll lend versus the value of the collateral, just to give you a bit of leeway in case the collateral drops in value. Now I'll tell you now the answer is D, but how do we get there? Well, if you look in red, we've got the market value of the collateral, 28,137,500, divided by 1.01 to take into account the margin. So this is the amount of cash you would actually lend. How much cash would be returned to you in 31 days' time? Well, take your principal and multiply it by 1 plus the rate of return you're earning on your money, 375, times 31 over 360. So European government bonds use actual over 360 for the rate of return on a repo. So this is your answer. This is your principal and interest after 31 days' time. Again, remember, you're earning 3.75 because you're the price taker, and the bank that's in charge here will give you as little money as possible on your deposit, or on your repo in this case. This next question concerns interest rate swap or IRS payments. Now you'll find this question on the internet, and there's a bank of ACI questions around there. So they've been around a while, so they still make reference to LIBOR. Now as you know, LIBOR disappeared from the markets by and large in June 2023, but you'll still see it featured on a lot of old test papers. What I've done is in red I've marked the bits which are relevant for you and which you need to take care of. Now the first line, calculate the net payments against a fixed rate of 5%. When we do swaps, we try and go for what they call netting, to have the net payments of the fixed rate versus the floating rate paid. You don't want the gross payments. If you have a gross payment, I run the risk that I pay you all of the interest on my side. You say thank you very much, and you fail to pay your interest in return. So not only have I lost my interest payment, but I haven't received what I was due. So we try and go for just net payments. Now you are paying 5% per annum, paid semi-annually. So that's what you're paying fixed every year. And in return you're receiving 6-month LIBOR on $10 million in an interest rate swap which has got 2 years to maturity. Now the 6-month LIBOR rate for the next payment date is fixed today at 4.95. So that means you'll be paying out 5%, receiving in 4.95, so you'll be paying out a net payment of 0.05% or 5 basis points. That's for the first 6 months. So for the first 6 months, you're paying 5 basis points more than you're receiving. You expect 6-month LIBOR in 6 months to fix at 5.25. So for the subsequent period, what will happen? You pay at 5%, you receive in 5.25. So you will be earning 25 basis points more than you're paying. So that's going to be your income on the next 6-month period on $10 million. Now, we've got the interest rates for 12 months and 18 months. You don't need to know those because we already have enough information to work out an answer. Now, on the 4 options here, A, B, C and D, on the first period it's saying that you can either pay 250 or receive 250. Well, we know that the difference between 4.95 and 5% is a lot more than $250, because if you look down here in red for period A, $10 million times 0.05% or 5 basis points times 180 over 360, because it's 6 months, is $2,500. So the answer can't be A, can't be B. So it has to be C or D. Now in this first period, if I'm paying out 5% and receiving in 4.95, I'm paying out, not receiving in. So the answer has to be C. So you'll see with this question, a lot of numbers, a lot of dates, but you don't need to use all of the information. Just think about what you need. If you did want to confirm it with the second period, for the second period you'd be paying 5%, receiving in 5.25. So for the second period you'd be receiving $10 million at 25 basis points for half a year. You'd be receiving $12,500. So yeah, the answer has to be C. This is a futures reval. So reval is short for revaluation, which is a terminology you'll hear in the dealing room. Now it says you're short of 6 December SOFR futures contracts at 98.10. What does that mean? Well, first of all, if you're short, you've sold, which means you're going to make money if the price goes down. If you were long, you would make money if the price goes up. Now the examiner's been sneaky here. They're doing this on 6 December contracts, not 6 December contracts. SOFR, SOFR, that's the secured overnight financing rate. And you did the originally, when the contract opened up, it's 98.10. Well, the 98.10 is actually irrelevant because all we're interested in here is this. It says yesterday the closing price was 98.15. Today's closing price is 97.905. What variation margin will be due? If you remember, variation margin is a profit or loss which is taken every day on your futures position. Cash goes into you, it goes out of you. Every day you're taking a profit or your loss, bringing the value of your position down to 0. Now yesterday the market was 98.15. It's gone down to 97.905, and you're happy if it goes down because you're short, you're going to make money. So how much money are you going to make? Well, I'll tell you now, the answer is D. How do we get there? Look at the difference between the close of business yesterday and the close of business today, which is 0.245. So 98.15 minus 97.905 is 0.245. That's 49 ticks. The easy way to do it is just look at the difference and multiply it by 2 to get the number of ticks. Now if you remember over here on the right, 1 tick move up or down is worth 0.005, which is worth $12.50. So 1 tick move is 0.005 on the contract price, 2 ticks would be 0.01, 20 ticks would be 0.1, 40 ticks 0.20 and 49 ticks 0.245. Basically, just take this number, multiply it by 2, with decimal point, so 0.245 is 49 ticks. Now we said that for every tick you make $12.50, you've got a profit here of 49 ticks, so on a single contract you would make a profit of $612.50. Well, good news for you, you haven't done it on a single contract, you've done it on 6 contracts, so your profit will be 6 times $612.50 or $3,675. Now you do need to be aware then that 1 tick is 0.005 for the dollar futures, and that tick has got a value of $12.50. Now this is an interesting question. This is on holding period returns, which sounds difficult. It's not. All we're going to be doing is saying, look, you've held an investment for a certain period of time. What's your annualized rate of return since you bought the investment in the first place? What I do here is I like to use a paper and pencil and just draw out the timelines. So let's take a look at the question. You buy a 181-day 275 CD certificate of deposit with a face value of $1.5 million at par when it's issued. So at par basically means you invest $1.5 million, you get a bit of paper that says you've invested $1.5 million. It's going to mature in 181 days time and it'll pay you 2.75%. So we can easily work out, knowing the principal and interest, what the CD will mature at in 6 months' time. Now you don't hold it for 6 months, you decide to sell it in the secondary market after 150 days at 2.6%. In other words, with 31 days to go. What is your holding period yield? In other words, if you invested 1.5 million, what's it worth in 150 days, and how much money have you actually earned on that as a percentage? Again, the answer on this is 2.775, but how do we get there? Look at what I've written in red. We know that if you've invested $1.5 million, the principal and interest at maturity will be found by multiplying it by 1 plus the rate of return on the CD times 181 over 360, which will give you $1,520,739. That's what it's due to give you at maturity. But we know that when we sell a CD prior to maturity, we discount that final payment back to the relevant date at the rate of return we want for the risk now, because the risk may have changed because of interest rates or credit spreads, who knows. But we know that with 31 days to go, if you want to take a 31-day risk on this particular issuer, you want a return of 2.6%. So what we do is we take the final proceeds of the CD, we discount them back by dividing them by 1 plus the rate of return we now require, 2.6%, and we're discounting back over 31 days. Again, this is a dollar money market instrument, actual over 360. That tells us that with 31 days to go, in other words, after 150 days, that's what the CD would be worth. So let's draw this out on a timeline. We've got our initial investment. We said we know what it's worth at maturity in 181 days. And with discounting, we've figured out what it's worth with 31 days to go. All I want to know is this. If I've invested $1.5 million at the beginning, and I'm selling my CD with 31 days to go, what is my rate of return in percentage terms over this 150-day period? Really easy to work out. The yield, what you've earned, is taken by finding the future value, which we know. This is the sale price of the CD, dividing it by what we paid for it initially, 1.5 million, take away 1. What we now do is we now gross that rate of return up onto a full year. Now we have to take into account the day count, and because it's dollars, we're going to put 360 for the day count on top. If it had been sterling, we would have put 365. And we're going to divide it by the number of days we were holding it for, 150. And there you are. There's our annualized rate of return for holding this investment over 150 days. So the key thing was to work out how much money did I put in, present value, what did I sell it for, future value, take away 1, and then annualize it grossed up to a full year. The world of foreign exchange. Now, when I put a title up like forward cross rates, it sounds complicated, but it's really not. We're going to do two things here. What we're going to do is work out a cross rate, which is just simply taking two FX rates and working out a third FX rate. Now, I've got sterling versus Swiss francs, sterling Swissy, spot. So that says that today, the base currency, which you know is on the left, says that £1 gets you 1 franc 14.85 to 1 franc 15.15. Here we have the saying, the quote that says 1 Swiss franc will get you so many Swedish krona. So that says 1 Swiss franc will get you 11 krona 98.75 to 11 krona 99 to 11 krona 98.85. What I want to do is I want to work out how many Swedish krona do I get to £1. You can see the Swiss franc is a base currency on one quote, but not the other. The Swiss franc is a base currency on the Swedish, but not on the sterling Swissy. When the base currency is not the same on both sides. What you do is very simply line up the two quotes above each other, multiply the left hand side by the left hand side, right hand side by the right hand side. So the bid by the bid side, the offered side by the offered side. That will give you the cross rate, which will show you how many Swedish krona you get for £1, GBP SEK. So far so good. We've worked out the cross rate. What we're now going to do is work out the cross rate, not spot but forward. Here it says 3-month sterling Swedish swap points are 725 to 690. What does that mean? Well, as you remember, one FX point goes to the 4th decimal place, 0.0001. Here it's 725 to 690. We're going from a high number on the left, 725, to a low number on the right. So what are we going to do with those points? We're going to subtract them. So from a high number on the left to a low number on the right, you subtract the points and vice versa. Well, first of all, I'll just show you the answer, 369.51. How do we get there? I said that if you take the two spot quotes, and you can see the Swiss franc is a base currency on one side but not the other, you simply put the two quotes above each other, multiply the bid side by the bid side, like that, and the offered side by the offered side, or the ask side by the ask side. And we get the two-way quote on spot quote for sterling versus Swedish krona. We said we subtract the forward points, or the swap points, because it's going from a high number, 725 on the left, to a low number, 690 on the right. And that's how we end up with our forward cross rate. So, sounds difficult, it's really straightforward. On this best FX quotes, again, read the question carefully. It says you need to buy $5 million against sterling and are quoted the following rates by two separate banks. So you're being quoted the rates, which means you're the price taker, you're not in control of the price. So two banks will show their bid and offer on sterling, dollar or cable. At what rate will you trade? Now, if you need to buy dollars against sterling, you're going to be selling sterling. So in other words, you'll be asking the other bank to bid the sterling off you. If the other bank is bidding the sterling off you, which would be the base currency, they will use their left-hand side, the bid side of the quote. So one bank will quote you 160.45, one bank will quote you 160.47. So if they bid or take the pound off you, they're going to be returning this amount of dollars. Which gives you the more dollars? Well, the second bank, 1.6047. So the key to this is to remember you're the price taker. The other bank, if you think about which way the cash is going, will be bidding your pound off you, saying thank you very much. Here you are, in return here's so many dollars. You can see the second bank will give you more dollars per pound than the first bank. On FX positioning, really important, as a trader you should always know your position at any given time and the average FX rate if you need to close a position, what's going to make you money, what's going to lose you money. Now we've got 4 quotes here. Now these quotes are all on dollar versus yen, on dollar yen, and on the first trade you sold $5 million at a dollar yen rate of 130.60. You bought $3.5 million at 130.20 yen to the dollar. You bought another $2 million at 130.50, and finally you've sold $2 million at 130.55. Well, what we need to know is what's your net position. Are you long or short? In other words, have you bought more dollars or have you sold more dollars, or are you square? And what's the average FX rate you've done it at? Now the way I do it is on the right. So these would be my workings. And I've written down the 4 trades. So on the first trade, I've sold $5 million, so minus $5 million at 130.6. So I've got $5 million going out of my account, and I've got 653 million in return coming in. My second trade, I bought $3.5 million for 445.7 million yen. For my third trade, I bought another $2 million, but it cost me 261 million yen. And my final trade is I sold $2 million at 130.55, so I earned 261.1 million yen. So add up what you've done on the dollar side and you'll see net, I've sold more dollars than I bought. I'm short $1.5 million. I'm long 197.4 million yen. So divide one by the other and it gives you this rate. So that's my average FX rate on my final position. So I'm short $1.5 million at 131.60. So if I was to buy the dollars back to square my position to bring it net to zero, I'd need to spend fewer than 131 yen 60 to buy those dollars to make a profit. So really important position keeping. And we got a final question here coming on repos again. Now, a lot of information just in the first sentence. It says the spot next repo rate. So spot next, that's spot 2 days from now going to the next day afterwards. So the 1 day period for the 5% bond maturing in 2028. So we've determined which bond is being used as collateral, is quoted to you. So you're the price taker again at 175 to 180. You sell bonds. So you're selling bonds. What does that mean? Are you a borrower or a lender? If you're selling bonds, it means you're borrowing cash. So you're going to be borrowing money here for 1 day. You sell bonds to the market value of 5,798,692 euros. So there's no mention of any margin here. So what we're saying is you sell the bonds with that value. That's the exact amount of cash I will lend you for this 1 day spot next rate. Now which rate, how much am I going to charge you to borrow this money? I'll charge you as much as I can get away with. Bear in mind you're the price taker, so I'll charge you 1.8%. So what happens is you sell these bonds, you get the cash in of 5,798,692 euros, and you're going to have to buy those bonds back 1 day later to take into account the interest that you've spent. So your principal and interest will be at the bottom here. There's the cash you borrowed, and you're going to have to pay back that cash plus your principal will increase by 1 plus the interest rate you're paying for it times 1 day spot next over 360. So that's the repurchase price for the bonds. So the key thing here was you're a price taker, you're a borrower, you're selling the bonds, selling collateral, so you're borrowing cash, and we know the maturity and we know the rate. No bank is going to lend to you at 175 when they can earn 180. Right, so that just brings me to the end. Just a few little questions of a variety there. If there are any other types of questions you have or want me to cover, let me know through the email address simon@swapskills.com or through YouTube or any other channel.